Welcome to the Deep Dive. Today we're tackling something pretty fundamental. That advice we all hear. Save your money, you'll be fine, maybe even rich.
Yeah, but what if that's not quite right? Or, as the YouTube video we're looking at today claims, what if it's actually a kind of money-saving trap?
Exactly, that's a bold statement.
Yeah.
So our mission here is to really unpack that. Why does the source call saving a trap?
And look into, what modern money even is, how inflation fits in.
And what the alternatives might be according to this source. We want to get to the heart of this perspective so you can figure out what it means for your own money.
Sounds good. Where should we start?
Let's kick off with that big claim. The source says if you saved every single penny from your first job, you still wouldn't become a multimillionaire today. They called it downright impossible for young people.
Right, which immediately makes you stop and think, doesn't it? The core idea is that just putting cash away in a standard bank account, well, it acts like this money-saving trap.
A trap? How so?
Well, the argument presented is that this system mostly benefits the big players, like banks, governments. It keeps people feeling like they have to stay in jobs, maybe jobs they don't even like, just grinding away until retirement.
And the source links this partly to education, or rather, the lack of it. We're not really taught practical money management in school, are we?
No, not usually beyond the basics of earning and spending. So you put money in savings, and it gives you this sense of security, maybe an illusion of control.
While the banks holding it are actually using that money to make, well, pretty big profits themselves.
Exactly. That's the dynamic the source describes.
Okay, so this really gets into a deeper question the source tackles. What even is money these days?
It's a great point. Because historically, money was tied to something real, tangible, like the gold standard, You could literally swap your cash for gold.
But that ended ages ago, right? In the U.S., it was 1933.
That's right. So now we have what's called fiat money. Currencies like the dollar, the euro, they aren't backed by a physical thing like gold.
So, what gives them value then? Just because the government says so?
Pretty much. It's based on government decree and, crucially, the collective trust people have in that government and the currency itself.
And that gives the government huge leverage, I suppose, over the economy, over how much money gets printed.
Absolutely. The source uses this analogy. Fiat money is a bit like monopoly money. It works within the rules of the game.
But the government sets the rules of that game.
And they can change them. That's the key point.
So if it's like monopoly money and the banks are holding ours, what are they doing with it, according to the source?
Yeah.
Definitely not paying us much for it.
No. The interest rates mentioned are incredibly low. The source cites rates like 0.5% as being well over the average recently, and the average savings account rate even lower, like 0.06%.
Wow. That's almost nothing.
It really is negligible. And while your money is just sitting there earning practically zero, the banks are using those deposits to generate, as the source puts it, huge profits.
So the source draws a contrast between, like, old school banking, just keeping money safe for a fair fee, and modern banking.
Yeah, they paint modern banks as being more hungry, always looking for new ways to increase income using customer funds. They even bring up the subprime mortgage situation leading to the 2008 crisis as an example.
Right, as a result of that drive for higher returns.
Mm-hmm. Now, the source clarifies they aren't saying banks are inherently evil entities. They're businesses acting in their own self-interest.
But the takeaway is that their interests might not automatically align with yours when it comes to actually growing your money. You can't just blindly trust the system to work for you.
That's the essence of their argument, yeah.
Okay, so given this view on fiat money, the source does touch on alternatives, things some people call God's money.
That's the term, yeah. Referring to gold and silver. They mention people like Robert Kiyosaki, who are big proponents of holding precious metals.
And the idea there is that gold and silver have real value, unlike fiat's promise value, because they're physical.
Exactly. They're finite resources, they have a long history as stores of value, and they exist outside of government's say-so. The source suggests for the wealthy, it's mainly about protecting the wealth they already have.
But importantly, the source author isn't saying everyone should pile into gold, right? Especially younger people.
No, that's a really key distinction they make. Holding gold is often about trading potential growth for security,
Okay.
which might be fine if you're already rich and just want to preserve it. But the source argues, if you're young and trying to build wealth, you can usually afford to take on a bit more risk for potentially much higher returns. The author says they personally prefer other assets over gold when they're young.
So security versus growth potential. It's a trade-off.
Definitely.
And as if the tiny interest rates weren't enough, there's this other huge factor working against savers: inflation.
Yeah, this is maybe the strongest part of their argument for why just saving is a potential trap. They use this really powerful example. Imagine putting $10,000 in an account earning 0.5% interest.
Which sounds better than 0.06% at least.
Right, and leaving it there for 1,000 years.
1,000 years. Okay, that must become a fortune.
Well, the number gets big, yeah, almost $1.5 million. But, and this is the kicker, if inflation averages just 1.5% a year over that time, that $1.5 million in the future would actually buy less stuff than your original $10,000 buys today.
Wow. Okay, that really puts it in perspective. The buying power just collapses.
It completely erodes. Inflation just slowly eats away at your money's value every single year it sits in the bank. The author even mentions their own experience, like how $1 used to buy way more snacks at the movies than it does now.
Yeah, we all feel that. They mentioned the U.S. inflation rate being around 3.67% when the video was made, though they thought it might be higher.
And they suspected the official numbers might be manipulated sometimes. They also broke down what they see as the causes.
Right, like demand pull.
Yeah, when everyone wants something and there isn't enough supply, like used cars during the pandemic, prices shoot up.
And cost push.
That's when the costs of making things go up. Materials, wages, so businesses have to charge more.
And the big one? Increased money supply.
Exactly. When more money gets created or pumped into the system faster than actual goods and services are produced, like stimulus checks during lockdown.
Each dollar becomes worth a little bit less.
Precisely. So you combine low interest with constant inflation. The source's point is your savings are getting squeezed from every angle.
It sounds like this perspective paints a picture of us living in what the source calls a consumption society.
Yeah, the idea is that we're sort of psychologically programmed, almost from birth, to think about money mainly as something you earn and then spend.
And the source makes a pretty provocative claim here, saying people have effectively been lied to by parents, teachers, society, pushed towards certain financial behaviors or goals that might not actually be in their best interest.
It's quite strong language. They frame it almost like that scene in The Matrix, you know, the blue pill or the red pill.
Stick with a comfortable story about saving,
Or take the red pill and see what the source argues is the perhaps less comfortable reality of how money and wealth building actually function in today's world.
And seeing that reality means changing how you think about money itself.
That's the core shift. Stop seeing money just as something to buy stuff with and start seeing it as a tool to grow your wealth. It's potential energy, something that can work for you.
But let's be clear, they aren't saying don't save anything, are they? Emergency funds are still important.
Oh, absolutely crucial. They definitely stress having an emergency fund, maybe 3 to 5 months of living expenses. But, and this is key.
It's only for emergencies.
Exactly. Not for holidays, not for a new phone, real emergencies. And it's not the place to park large sums you want actually grow over the long term.
Okay, so if saving in the bank is the trap, what's the escape route? How do you beat the system, according to this source?
The main alternative presented is investing. They point to history, the stock market historically averaging, 8-10% returns per year over the long haul.
Though obviously past performance isn't a guarantee of the future, and there's risk involved.
Absolutely. They acknowledge the risk. But they contrast that potential return with the near zero return of savings and argue it's a much more effective path for wealth growth.
And they make it sound pretty accessible too, not just for millionaires.
Yeah, the strategy they outline is actually quite simple for getting started. Use an investing app, buy a low-cost index fund, they mention one, tracking the S&P 500 as an example, and just hold on to it for the long term.
What's an index fund? Again, just quickly.
Think of it like a basket holding tiny pieces of lots of different companies. So an S&P 500 fund gives you exposure to the 500 biggest U.S. companies all at once. It provides instant diversification.
Got it. Makes sense. And they had some tips for choosing an investing platform.
Yeah, 4 things they highlighted from their own perspective. First, look for transparent, low fees, especially no fees for buying ETFs, because even a 1% fee adds up hugely over time.
Compounding works against you with fees.
Exactly. Second, the ability to invest in money market funds. These can offer better interest than savings by investing in short-term debt.
But, and this is important, they are not insured like bank savings, right? You could technically lose money.
That's the vital distinction, not FDIC or government insured. generally low risk compared to stocks, but riskier than a savings account. There's no guarantee.
Okay, what else?
Third, maybe a multi-currency account, if that's relevant to you, one that pays interest on cash you haven't invested yet. They cited rates up to 4.5% for pounds and dollars.
Much better than 0.06%.
For sure. And finally, just having a good range of investment options available, lots of different stocks and ETFs. They mentioned the platform they used had over 3,500.
This whole conversation really highlights the idea of opportunity cost.
Yeah, that's a huge underlying theme. What are you missing out on by keeping money idle? The source mentions people liking the comfort of seeing the number in their savings account.
But they don't see the invisible cost, the inflation erosion, and the potential growth they forfeited.
Right. Think about people who sat in cash the last few years and missed major market moves. The source puts it bluntly. The biggest risk often turns out to be not taking one at all.
They used Tesla stock as an example, didn't they? A quick jump.
Yeah, just a few months in 2021, August to October, it went from around $700 to nearly $900. That's a 35% gain.
So the opportunity cost of not being invested just during that short period was huge.
Massive. And they point out with fractional shares now, you don't need $700 to buy Tesla. You could put in $100.
And to potentially make $35 in that example instead of pennies in interest.
Exactly. Compare that 35% potential gain, or even the market average of 8–10%, to the PNR 0.6% average savings rate. There's just no opportunity here, as the source says, for real growth in a basic savings account. Meanwhile, the bank is lending your money out at much higher rates.
So it reframes money's purpose. Yes, some for emergencies, some for enjoyment, but a chunk needs to be seen as a tool for investing. You don't need it all instantly available.
Precisely. Not on hand 24/7.
The source kind of characterizes keeping everything in the bank as maybe boomer thinking, a strategy from a different time.
Yeah, suggesting it might have worked better decades ago when interest rates were higher and maybe inflation was different, but the game has changed. It requires adaptation.
But they seem optimistic too, like people are starting to catch on.
Definitely. There's a sense that more people are taking control, learning about investing. The core message keeps coming back. Money is a tool. It's meant to be used.
Not just hoarded. Let it go out and play.
That's the phrase they use. And for people worried about risk, they offer that perspective. Often, the worst that'll happen is you'll be back where you started.
Which leads to that classic quote they finish with.
You miss 100% of the shots you don't take. Wayne Gretzky, right? Applies to finance too, apparently.
So wrapping this up, what we've really explored from this source is a pretty fundamental shift in thinking, isn't it?
Yeah, it's moving away from that default mode of just saving, hoarding money for a feeling of security.
Towards actively using money as a tool to potentially generate more money. Accepting that involves a different type of risk.
And the source really challenges the idea that a savings account is truly safe once you account for inflation's silent theft and the opportunity cost of missing out on potential growth elsewhere.
It leaves you with that final, quite provocative thought. Is your money just sitting on the sidelines?
Or, as the source puts it, is it out there playing for you, making it work towards your future? Definitely something to think about.